Welcome to TXOGA Talks, where energy meets insight. The purpose of this podcast is to provide you with a candid conversation about our energy needs, our energy security, and your energy future. Texas oil and natural gas have made our nation the world's energy leader, constantly innovating and investing to fuel the economy, protect the environment, and power the world. This industry is fast-paced, high-tech, and essential to improving modern life. And we're here to talk about it. You're listening to TXOGA Talks, where energy meets insight. And welcome back to another edition of TXOGA Talks, where we really try to bring to the forefront the issues that are impacting your families and ours, the issues surrounding oil and natural gas that really determines the future of the Lone Star State. I'm glad to be back joined today with Shana Joyce, Vice President of Government and Regulatory Affairs at the Texas Oil and Gas Association. And we're excited today to be discussing again with Dean Foreman. Dean is a PhD economist and chief economist at TXOGA. And we're going to be talking to you today just about the different issues that you may be reading about in the news or hearing about on the evening channels or on social media. And we want to give you our take and our perspective. And to start it off, we really want to talk to you about Foreman's 4. Dr. Foreman does a good job of zeroing in and giving some highlights of things that really do affect our lives, our future, our economy. And Dean, we're glad to have you back with us today for sure. And we've got 4 topics that we want to go through with you today. The first topic is economic growth and interest rates. The Fed Reserve has been talking about it a lot. If you have a lot of money you want to get some interest on, I feel for you because the rate you're going to be earning is declining, I think. But if you want to buy a new home or you want to buy a new car, the interest rates that you're going to be paying are going to be dropping. So, Dean, give us your take on economic growth and interest rates.
So all eyes have been on the economy and recent economic releases. And there are times when good news is good news, bad news is bad news, and times now when bad news is good news. and what's happening is that you're getting legitimately weaker readings of economic growth, more muted price inflation, and it's setting the stage for the Federal Reserve to begin to cut rates. And the financial markets look at this as not just a one-off, but a cycle of easing of interest rates. So even though we're hitting a soft patch in terms of growth, and it's not shown up as much on the industrial side as it has in terms of consumer stress, it really is a pivotal shift where bad news is leading to the prospect of a softer consumer impact as a result of interest rate sensitivity. So if you've got credit cards, if you've got auto loans, these are really interest rate sensitive sectors.
And these are a benefit to you if you have those types of loans.
How soon do you see that kind of happening in the future, in the next couple of months or by the end of the year? What are you thinking?
It's a good question, and reasonable people can disagree, but they're signaling that they'd cut by maybe 25 basis points. It could be more.
Okay.
It would surprise the market if it were, but 0.25%
Yes.
in September is kind of what they set the stage for. And the market threw a fit last week, the financial markets, with a lot of volatility, kind of clamoring for more immediate rate cuts, but I don't think that's in the cards.
Someone told me this week that there could be 5 cuts this year. That seems a little aggressive, though, to me. I don't know what your perspective is on that.
Well, we came into this year, began in January with the market expecting as many as 4 to 6 cuts, and then we'll be lucky if we maybe get 1, right?
Oh, wow.
And then next year, the dot plot, that the expectations are more like 3, something like that for next year. But again, whether they move a lot, it's going to be very data dependent and kind of the path that things take.
I also heard this week, and he didn't give me authority to say the person that gave me this quote, but he said his father-in-law told him, nothing is too bad or too good for too long.
I think
Something
that's right.
to think about, right?
I think that's right. Sometimes when you're, I'm going to compare this to parenting, you just kind of have to embrace that hard moment because you're going to push through it, right? And so I think that's the same with interest rates.
So you get economic advice here, you get mental health counseling, parental counseling. This is your all-in-one podcast.
That's
here.
right.
There you go.
One-stop shopping.
So what is happening in our economy is we're not insulated from what's going on around the world. And so, Dean, on your second point of the Foreman's 4 today, give us your take on geopolitics in the Middle East.
So it's geopolitics, but it relates back to this interest rate discussion as well, and the pluses and minuses, and explaining what's happening with oil prices. And if you've noticed, oil prices have been all over the place recently. They've been up, they've been down. Every time you have Middle East geopolitical uncertainties involving Iran, the Straits of Hormuz, and so much oil trade that goes through that, there's a definite premium that shows up in oil prices day to day on that basis. But as you'd expect, after that knee-jerk reaction, as people expect perhaps slower growth, the soft patch that we've talked about, well, that means lower oil demand on a global basis, so then prices pull back. Well, then the market says, well, wait, now there's going to be a rate cut. And if you get a rate cut historically, that means a weaker US dollar, an inverse correlation with oil prices, and hence pressure back up now on oil. So geopolitics and financial market stuff kind of coalesce around higher prices, weaker growth, lower prices, and the sentiment battle is kind of battling it out day by day right now. But if oil's the leading indicator, right now, oil has kind of stayed in this range.
Yeah, it's been hovering in there, and it's been in the low 70s and the upper 70s range for WTI. Yeah, you mentioned oil demand, but I saw some really good graphics that you prepared on some of this information. Shana, do you think we can get those graphics put on the website?
Yes, we can. And I'll also tell our viewers, you can go to TXOGA.org/economics, where you can see all of the graphics and charts that Dr. Foreman puts out, and they're awesome. So we'll put it up.
Can everybody get this? You don't have to pay to get those?
You don't have to pay to get that.
Free.
That's for free.
Okay, all right, well, good.
Well, there's no free
why?
lunch.
It's because it's really vital information and things that are top of mind today as we're talking about this. But it's very in depth. So if you're really into that, I know you're really into that.
Yeah, I love it. I really do. It's nerdy that way. But economics is fun stuff.
These chart books are for you.
I talk to Dean. It's just great all the time. Dean, you've talked about interest rates and the impact that it might have. You talked about geopolitics, but you also mentioned oil demand in that conversation. So that's your third point today. What do you have to tell our viewers about oil demand and how this intermingles?
Well, just to be clear, because it's really easy to get lost in the messaging and the politics, presidential election politics.
Oh, is there an election?
Wait,
is there one? I missed it. Oh, my.
That's actually a good point, because I would like your take on how the presidential race kind of factors into kind of what you look at and what economists look at in all of this. But you can talk about oil demand first, and we can go back to that.
Well, it's actually a good lead into the demand story,
perfect.
because you don't win an election as a challenger by not making people discontent with what they already have, right? So you have a lot of advertising and a lot of messaging going around trying to either reaffirm, yes, what you have is good or not, and then the consumer sentiment battle around that. And for demand, the key message here is that mediocre economic growth, mediocre signals are records. Like on a global basis, this quarter per EIA, and EIA is lower than other official agencies in terms of their global estimate, 103.6 million barrels per day right now.
Wow.
This is the highest of any quarter ever.
Since the
history
ever,
period.
Period.
Okay.
On top of this, expected to hit 5 consecutive quarterly new records between now and the end of 2025, exiting at close to 105 million barrels per day next year.
Wow.
So this sets the stage for continued stock withdrawals. It says that despite OPEC having taken some oil off market, the demand is it's really strong. This is emerging markets driving it, by the way.
I want us to dig into that a little bit more about these new record production amounts that you discussed. And I think we spend a little more time on that, but I want to get through the former before
we can
do
go back to that.
The last thing that I think that we want to highlight here today for our listeners, I read a lot about the Strategic Political Reserve. I'm sorry, the Strategic Petroleum Reserve. Oh, can we cut that?
That's not Freudian.
Oh, no. It's the Strategic Petroleum Reserve, folks, SPR. And there's been a lot of comments about it, Dean, what it does to oil prices, what it does to gasoline prices. That people talk about refilling the gasoline reserve when there's not even really a real one. I mean, it's a small one. And so kind of give us the high points that listeners should know about the Strategic Petroleum Reserve.
The Strategic Petroleum Reserve, or SPR, was set up after the Arab oil embargo in 1974 with the idea that America needed protecting against potential supply disruptions on a global basis. Now, over time, the remit for this has kind of broadened, and the administration, especially this administration, has used it more to try to manage prices. When you properly account for monetary policy, it really has no impact on prices. That much is clear. From an academic study to just the common logic in terms of the volumetrics that we're talking about.
Because it's a small pebble in the ocean is what you're saying.
Truly.
Is that right?
Truly.
Okay.
I mean, when we're looking about the amounts that have been released. Now, this year, they've, by a trickle, started to rebuild the SPR, which has been at 40-year lows, like the lowest since 1983, sitting just under 380 million barrels in the SPR.
Has it been
right now.
40 years since 1983? I just had it. That's not comforting to me to think there's been that much. Anyway. Birthdays. Okay.
Time flies.
Okay.
Yes.
Time flies.
I was doing some math in my head.
Yeah.
Okay.
Go ahead. I'm sorry.
No, I don't even know. I got so distracted by that. Go ahead. Sorry.
Well, the thing that's clear over 40 years is that demand in the U.S. is 30% higher for oil and petroleum products than it was in 1983. So other things being equal, you would think that you'd have to have higher reserves to have the same number of days of coverage of consumption. But then we tout the production records for the U.S. and Texas that we've been talking about. And you say, well, wait a second, the U.S. produces a lot, so we don't need to hold as much in reserve as we used to. That's the logic.
Okay.
But it only holds if you're willing to not export during a critical time. And because of what's been happening with this growing and potentially expanding conflict between Iran, Hezbollah, Hamas versus Israel, that draws into question of, if you get a real supply disruption, are you, administration, willing to not export crude oil and refined products to our allies around the world? And that's been threatened by Secretary Granholm and others over time. But if you're not willing to play that card, then you have to rebuild the SPR. And they have been, but only by 5 to 6% so far this year. We, in the last 6 weeks alone, commercial inventories of crude oil were drawn down by well over 30 million barrels compared to less than that that's been rebuilt in the SPR all year. So we've blown through that, and we're sitting here now with total crude oil reserves for the U.S., including the SPR, that are basically in the bottom 10% of all weeks that we've seen on record in 40 years. So you got to ask whether that's prudent policy. And I think given the geopolitical uncertainties on top of the economic uncertainties, we need to think about this, coupled with strong demand both domestically and internationally.
I feel like we need an attorney to come on right now and say what they say about the stock market. Individual performance may not represent everything.
Sure.
Because in economics, there's macroeconomics and there's microeconomics. And so if you're in a market that has constricted access to oil or gasoline, then that volatility is going to drive your prices up, or if there's a flood in that area. So economics is a big word. And it has a lot of impacts depending on the individual circumstances, I think, is an important thing. You heard Foreman's 4 today, and I'm excited about that. I want us to take a little bit of time when we come back from this commercial break and talk a little bit more about some of these issues in depth and issues that you might be thinking about as you're reading the news and listening on a daily basis. So stay with us. We'll be right back. Thanks to a partnership between TXOGA and Blue Cross Blue Shield of Texas, now more than ever, it's easy for small businesses to provide affordable group health coverage for their employees through the TXOGA healthcare plan. With a TXOGA plan, members can choose the right healthcare plan and benefits for them, priced within their budget, with the physicians and providers they trust. TXOGA's healthcare plan is available to small businesses with between 2 and 50 total employees who are headquartered in Texas, members of TXOGA, and aligned to the Texas oil and natural gas industry. If your organization is not enrolled but looking for coverage, visit bcbstx.com/TXOGA. I'll say that again. Visit bcbstx.com/TXOGA to learn more. Visit today.
Welcome back. We've heard some really great insight from Dr. Foreman on the Foreman's 4, and I think, Todd, you wanted to dive in a little bit more when we talked about oil demand. We were talking about that from a global perspective. So what did you want to, let's expand on that.
I think Dean, you mentioned about the all-time highs. I think these record production amounts are something that we shouldn't gloss over. They're very impactful on the scene. It enhances the United States energy leadership, our energy security, and folks, energy security means national security.
That's
Just
right.
another way to look about it. So let's talk about this demand and production records, demand and supply, the basic components of economics.
Yeah, I mean, you can't have that demand without the market stepping up to supply it. And that demand's been getting met despite the fact that OPEC has pulled a couple million barrels per day off of market in the last year or two. So that means the U.S. is continuing to hit record levels in production. Texas as a state, officially in the latest data from EIA as of May, but through our projections through July, also hitting records above 5.7 million barrels per day of crude oil. And by the way, it's not just crude oil. The liquids that are extracted from natural gas, they're adding another almost 3.5 million barrels per day in Texas alone. Actually, I think as high as 3.8 is the record there.
So you add that amount to the 5.7 to get the real energy produced here, along with gas, I assume.
The liquids and a lot of those NGLs end up going into materials, into the things that everybody around the world wants in terms of consumer goods, plastics, polyethylene, the building blocks for petrochemicals. So it's really important that this, the U.S. wide, out of that 3.8 max out of Texas, 6 million barrels per day, a record recently as of May for NGLs out of the U.S. So you add, 6 of just NGLs plus a record U.S. 13.3 million barrels per day. Currently, we're above 19 million barrels per day of total liquids there. Just on that basis, EIA then adds everything from refinery gain to biofuels to get a total liquids estimate over 20. But this is why we're so important in terms of the production growth that's continued to happen. And that's been ample, plus longer lead projects that have come out of Guyana, Brazil, Norway, Canada. Those have come to fruition this year in a way where the market's really well supplied despite these record demand levels.
Now, Dean, listeners who may not keep up with this on a daily basis like you do and that we do, you're talking about new production records, new volumes. We're talking about other countries that are throttling back some. But in the United States, the rig count has declined substantially from last year to this year, to the tune of over 100 rigs per day that are operating. So kind of share with our listeners, how in the world are we producing so much but using fewer rigs?
The answer is productivity. I mean, it's remarkable. When we look at the Permian Basin in particular, EIA's estimates of how much more oil and gas you get for running a rig for a month compared to last year, the gains are over 20%. 20%, 20. So this is huge productivity in terms of how much you can get for a given rig. And it means to invest and sustain production, you just don't need as many rigs running.
I talked to a company the other day who said 2 years ago they were running 23 rigs. Today they're running 16. That's about a 30% reduction over that two-year period that supports that 20% number that you just discussed. I think that's impressive. And it's happening because of ingenuity. It's happening because of research and development and really just pioneering technological breakthroughs that these companies are investing in to produce more, have lower emissions profile while we're doing that. Carbon dioxide emissions have declined. Methane emissions have declined, all while production has increased. And that's a real story of American success, I think.
I also think about these production highs that we're hitting and how that will impact our coming year, our coming fiscal year for the state. We are going into a legislative session this coming year. So I'm really interested to see our energy and economic report for next year to kind of see how all of that plays into this. Because if you recall, when we talked about it last time, there was like the October of 2022 was like a very pivotal month. So it'll be interesting to see what tracks next year.
And we'll be having that report. Dr. Foreman and his team are working on that now. We'll be releasing that in January of 2025. So mark your calendars.
That's right.
We know you want
Save the date.
But it's big news for policymakers who sit in that building behind us today.
100%.
Because the state budget, where we fund our public schools, we fund our public roads, we fund universities, we fund first responders, the amount of revenue they have is dependent on how well oil and gas does.
That's exactly right.
And think of it in context, the $26.3 billion of state and local taxes paid last year by this industry in the state of Texas, that exceeds the total revenues, the total tax receipts of 36 states.
Wow.
It's a big state in and of itself.
No, wait a minute. Let's just
industry.
put that in context. This industry in Texas pays more state revenues than are generated in 36 other states. Folks, that's amazing. That means you don't have to live in the middle of the oil patch to benefit from oil and gas. That's exactly what that means. That's great news. I love it. One thing, though, that has come up, and we issued a press release about this, even though we're producing more, our rig counts are declining, and that means employment has dropped some in our upstream sector. And so it's amazing to me that we can continue to produce as much as we are, and we're doing it with a little bit fewer people, and it's the men and women that are making these things happen.
It absolutely is, and they're making huge contributions along the way. And there's a mix of jobs. Now, the data that you're referring to are the latest monthly things showing a slight decline in terms of industry employment.
Right.
On a quarterly basis, the most recent data from the census only go through the fourth quarter of last year, and we're waiting day by day to try to get the first quarter of this year. But those data cover all sectors, not just the upstream resource development, but all the midstream transportation, the exports of LNG, plus all the downstream conversions, so refining and petrochemicals. And the more we produce and the more economic it is, we're also seeing job gains in what we do with that product.
See, I think that's an important message that sometimes gets left out, that of the other sectors that are actually growing. And then we also have carbon capture and storage, which is a
whole new business,
which is proven technologies that are being implemented that are resulting in lower carbon emissions. And Shana, I want us to do a really deep dive on carbon capture and storage, because listeners may be hearing about it. There's been a lot of investment there. Mm-hmm. There are jobs that are being created. There's taxes that are being paid.
The federal government's giving out money regarding it. I keep seeing press releases about grants that they're giving out on carbon capture. And I think it's a lot of buzzwords, and we don't quite know, like, what does that actually mean? Sure. I would like to learn more. So doing research for that episode will be perfect.
So there's a couple of more categories that I think we should cover today, because I think they're topical. And two different categories. One is the energy mix globally, and the other one is what's going on here in Texas that you spend a lot of time on, Shana, with electricity.
That's right.
And Dr. Foreman helps us that as well. What I want to talk about the energy mix, we had the opportunity to have George Will be our guest speaker at our annual meeting here a few years ago. And he's a brilliant columnist. Obviously, I have to have my dictionary out when I read his columns. He uses terms I don't use in East Texas. We use some other ones, but I won't share with you all today. But George Will said, look, 1865 was when oil was basically discovered by Colonel Drake in Pittsburgh, right, in the 1860s. The predominant energy source for the world at that time was coal. It took 100 years before oil overtook coal to be that predominant energy source. But 100 years later, we're using more coal in 1965 than we were in 1865. And so, Dean, I think when we talk about energy transition, I think what that means to me is we're going to be, yes, transitioning to different forms, newer forms of energy. Our companies are leading hydrogen, ammonia. We know that there are weather-dependent resources that are out there today that are growing. But what is your take on this energy mix and how energy leadership might be shifting?
Technology is going to continue to evolve, and there's definitely a transition that's ongoing. But at the end of the day, from a global basis, this is really an energy expansion, not just a transition. To take BP's energy outlook, and BP is certainly all in with the energy transition. They've put their money where their mouth is in terms of investing in renewables, and they project that global coal demand will be higher in year 2050 than it is today, despite everything.
Right.
So up we go, down we go. There'll be a mix based on the economics. So nobody knows for sure exactly how the inter-fuel competition will play out here. But things like carbon capture, use and storage that we just talked about, those are things that really enable all of these to compete on a level playing field, because once you're doing that, you are addressing the environmental concerns at the same time as you're getting economic resources where consumers need them around the world.
Shana, he mentioned energy expansion. I think that's a key term that I wish the media would use more than energy transition.
That's right.
Because it's an energy expansion. Because if you don't expand energy, folks, what that means is you artificially constrict the energy that you have access to. And when that happens, prices go up.
Mm-hmm.
I mean, when you artificially limit the supply of something and you still have that growing demand, which EIA is forecasting all the way through 2050, that means your prices will increase. And so if we want families to have affordable, reliable energy, I think it's important that we continue to have that energy expansion and not have artificial barriers. So when we talk about families having access to energy, Shana, an area that you spend a lot of time on is electricity. And having reliable power supplies is very important, as we've experienced recently in a hurricane, right?
That's right. And we are at a state level, we're talking about, we talked about this when we talked to Chairman Gleason about the Texas Energy Fund.
Yes.
We're investing in dispatchable and thermal generation here in Texas. I know we talked about geographic locations and kind of spreading that out a little bit. But Dr. Foreman, you actually had a really great slide or a chart in one of your chart books that talked about the thermal and dispatchable resources generated as much as 94.7% of ERCOT's electricity. And that was for the month in August, right? But we've seen that a couple of times this year. You want to expand on that a little bit?
We've seen that regularly during non-emergency conditions, and that's really important to underscore that it was one thing in January when it was Winter Storm Heather, but through our chart book on a weekly basis, we're tracking what the energy mix is in terms of generation across ERCOT. We're also looking at the load distribution across regions and all of this. Mm-hmm. But it's been really important to see 94, 95%, that it'll be a certain morning for an hour or so that's occurring. But it says that when you go through a time when you just naturally don't get wind or the
don't
sun's
have the
not
solar,
shining,
right? We haven't
and it's
quite
not
woken
to
up
beat
yet.
them up, but you can't throw enough money at that to actually get what you need from a grid stability standpoint. So you have an interesting policy debate going on where a lot of federal subsidies have kind of over-incentivized building out renewables. And as a result of that, we're looking at a grid here that's struggling through various policies to try to compensate for the most intermittency in the nation. We've got nation-leading wind and solar. That's a great thing from an environmental perspective, but we have to have a grid that's safe and reliable and consistent through this. So these are the policy challenges for ERCOT that are ongoing, of trying to address this through things that don't harm consumers at the end of the day.
That's right.
Well, we know that at a recent Senate committee hearing, it was ERCOT made the announcement that load growth for generation needs were going to go substantially over the next by 2030. Transmission needs were going to grow, and then, but sometimes those forecasts are always not realized. And so we want to continue to grow in Texas. We want to bring jobs here. We want to welcome all variety of industry, and we want a reliable grid. And so I know that ERCOT, the Public Utility Commission, Governor Abbott, Lieutenant Governor Patrick, and Speaker Phelan have all made this a priority, as well as the members of the House and Senate. And so I'm very confident that our state will rise up to meet the challenge. And we'll dig into that a little bit more. We ought to do a program on the Texas Energy Fund. And
that is on our schedule.
Good.
Yes.
Good. That'll be great. We'll get that rolling here pretty quickly for sure. One more quick topic before we wrap up today is infrastructure. We've talked about infrastructure needs and electricity there just briefly in terms of power lines, transmission lines, generation.
We didn't talk a lot about transmission, but that is something that continues to be important, especially for the Permian Basin. There's a current plan going on for that right now, the Permian Basin Reliability Plan, which you're constantly battling or constantly trying to balance generation and transmission. So that's another topic for another episode.
Well, before we leave it, though, you mentioned the Permian Basin, which is the most prolific, most important oil basin in the world today. Why is transmission needed in the Permian Basin, Shana?
Well, it's been historically underserved for over 10 years, for over a decade. And if we're going to continue to meet these goals that Dr. Foreman is talking about and these, huge production, we need electricity. And so the Public Utility Commission will start looking at what is the best plan to serve that historically underserved area.
Good. Well, I know those operators are ready to go.
That's right.
We've got some great service providers that are ready to help build.
Yes, the transmission service providers have been a really good ally in that.
Yeah, well, good. Well, we've got ready and willing customers.
That's right.
That are ready for these resources.
That's exactly right.
So not only is transmission lines for electricity important, but pipeline infrastructure is important as well. Dr. Foreman, if our listeners have been watching natural gas prices at all, they've seen negative pricing for, I think, about 60 trading days this year out of the Permian Basin and Waha. The prices that I've seen on the average is average below $2. So do consumers benefit from these lower natural gas prices, and how?
So the benchmark at Henry Hub, Louisiana, the largest trading hub in the U.S., is not disconnected entirely from Waha Hub in West Texas. But the interesting transition, and we'll relate this back to the change in rig activity that we were talking about, is that dedicated drilling for natural gas has kind of fallen by the wayside, right? We only have 25 rigs running for that in Texas currently. But the vast majority of the rigs are chasing oil. They're in the Permian Basin, and they're producing a lot of natural gas that comes with it. And then it becomes an empirical matter, a business case, as to whether it justifies building more natural gas pipeline infrastructure from remote West Texas to market centers, or whether it be, for example, more economic to locate cryptocurrency mining or a data center, something that could consume natural gas for power directly in region. So that's where infrastructure providers are struggling, midstream companies are struggling with, do I build it? Do I not build it? How sustainable is this? But in the meantime, it means with these negative prices that I've got to pay somebody to take away my natural gas for a short period. Then in other months it goes positive. But generally, it's this extreme production growth that we've seen in the Permian that's been a huge benefit to consumers, and it is producing natural gas along with it, but also is benefiting consumers.
Yeah, because you're, someone that produces electricity from natural gas is obviously that input cost is lower, and consumers should be benefiting. If you're not, you need to call Shana, and she'll no. You should be. That's the way the market's supposed to work. Right. But I'm going to recap. The reason the prices are negative in West Texas is why?
You're producing more than there's market for. There's limited pipeline egress out of the region. So basically, you're at the point where you're paying for limited capacity to get out of the region.
There just hasn't been the ability to catch up and build the pipelines that are necessary for this extra gas that's coming online.
And it's also seasonal. So in the winter, there would be enough local demand for natural gas, for heating, for example, to justify positive prices, coupled with the exports from that region. But you get to May, and the demand's dropped off, and it's normally the injection season when you're putting gas into storage, and you just don't have enough local demand to provide it, plus the egress to provide. It
sounds like some enterprising group of investors
markets will solve
put a natural gas fueled electric generation station in West Texas and take advantage of this low price natural gas and benefit everybody.
This is not Field of Dreams.
How about that?
It's not Field of Dreams.
It can happen. 6 months, I'm going to go work on this project. I wish I could. That'd be fun. But there's a lot of need for it. And we know that Texas population is growing. Our businesses are growing. We went this whole program without mentioning AI. How many podcasts in America have gone this more than 5 seconds without mentioning AI and its impact on drawing energy to generate the computer models that it does.
And that's a huge factor into AI, data centers. All of that is a huge factor into the load growth here in Texas because everyone wants to come to the greatest state in the nation.
And they should.
And they should. So come on, but we want to make sure that we have dispatchable and reliable energy.
That's right. Well, folks, we thank you so much for joining us today. It's been another episode of TXOGA Talks, where energy meets insight. We're glad to have Dr. Foreman, Shana, Joyce discussing things that we think are important in your life. If you have ideas that you want to hear about, please email us. Go to our website, texoga.org, and you can find a way to contact us. And we'll give you Shana's home phone number here shortly if we keep going for a few more minutes.
If I had, you can have my landline number.
Yeah. I think I know what that means. Thanks for joining us. We look forward to the next episode.
The views expressed on this podcast are not intended and should not be construed to be the views of any particular TXOGA member or company. The purpose of this podcast is to engage in candid conversations about energy needs, energy security, and the future of energy.